Part of reading a chart is reading important patterns that are important to the market, but they're not obvious to the market. And people don't read them this way. This is why you want to stay in touch with them. Forget about head and shoulders and forget about double tops, bottoms, all these more popular in the book type of patterns that you see. You want to see where the fight is, where the congestion is. And you see me in real time highlighting it in yellow. And I'm not just doing it in the ES, which is this market, but the NASDAQ, which is this market, and the Russell, which is this market. All right. When you're starting to get some markets that begin to show the same pattern in three related markets, remember, they're all stock markets, that gives you a little bit more bang for your buck. Let me back it up and show you. Back it up right there, and I'll pause it. I'm throwing in a highlight here to show you the top of the most recent price action. You got some swing highs over here. You had some top of the box, as we call it, right here. And so if you want, you could draw a box and kind of visualize it like that. Understanding why a box is important. All right. Same thing here in the NASDAQ. There's their box. They have a little bit one in the Russell, where before this box, you had this box that was really nicely drawn and understood. Take a look at these swing highs that they have. Now, the novice, the guy who has gone down rabbit holes his whole trading education career, would look at all these X's I just drew and say, that's some really good resistance there. BS. Terrible resistance. It's already worked. You might have been right by saying it was good resistance, but it is not still good resistance. The more it's worked, the less likely it's going to continue to work. And they blew out through it, and then they came back and used it as support. All right. That's not what I'm trying to make. The point I'm trying to make. The point I'm trying to make is when you get confluence between related markets, the NASDAQ is going to relate to the ES, the Dow to the Russell. They all represent equity markets. And so when you see me drawing all this, it's like when you get into that yellow square, you're going to get shorts to say holy SHIT, and they begin to chase. Shorts that chase and are swearing are buyers. When there's enough of that, called buying, is when you get markets to go up. Remember, the price of anything doesn't go up because people buy it. It's because people want to buy it and they can't get filled. There's a difference between people wanting to buy it and getting filled, and people wanting to buy it and not getting filled. And people don't separate that definition or even understand that definition. And yet they're trying to predict price and they can't explain how the damn thing moves. So when you get all this and you're not recognizing it, then you're going to put yourself, as I call it, your heels on the edge of a cliff, and just one little push and you get this dynamic of a bunch of shorts chasing. Shorts are buyers. And when shorts are chasing, that's buyers that are chasing. It's like four people bidding on a house. Price of that house is going to go up. Not all four people are going to buy that house, but they were all instrumental in the direction of that damn price. All right, so then when we play this thing, you could see they begin to chase here in the ES through, and you look at the price through like 99, and as you pause it, you could see the or the NASDAQ over here on the right side actually led it. And they started to explode through the top of their box, and then the ES was able to chase. Your job is to recognize this, to make it part of your step 2 or your step 3, part of your aim, fire, and ready, aim, fire. You know, there were people in here that were already bullish at this particular time, looking for the top to get taken out. And they actually found their trigger when a big sell pulse comes in. That's this little purple rectangle. And the price couldn't go down. You could see it right in here in the footprint. It's just 100 contracts, but it's not the size of it necessarily. It's the reaction to price when you see big orders come in. Get out of your head about just recognizing orders. Start understanding the intent of the order. Can you figure out if the order intended to open a long or cover a short? Even what that means. There's a lot of people that don't even understand what that means and can't explain it like the back of their hand. You buy to get long. You could buy to cover a short. You could buy to cover a spread, to open a spread. What does all that mean? You could buy to reduce your exposure, or create exposure in cash markets. But that aside, get into the intent of an order, and then the relationship and the reaction to price when you see a big order. Price is what we're trying to predict, correct? So it's like one of the two dancers on the dance floor. Price and orders. Orders are made up of buyers and sellers. Price and orders. You see a big order come in and price doesn't go down, and it's not even close. It rejects it right away. Now, we don't know it's going to do that at this very moment. All right. It's a probability game. But to read order flow means big sell pulse, and we're right above it immediately. And oh, by the way, they've got the top of this box they're eyeing to really piss off shorts. And oh, by the way, the same thing looks to be setting up in two other cousins, the NASDAQ and the Russell. Right? Does now things start to make sense? Because you know why price moves, because you know and understand predicting prices about other people's positions and stacking probabilities. Being wrong, but being okay with being wrong because we're not wrong for long. It's the guys that keep predicting that the downside's the right side for 20, 30, 40 points. And eventually they're right. But who's going to make a living taking 40 points of heat? Who's going to build your size taking 20, 30 points of heat in the S&P? Not going to happen. So again, you got to put yourself in a position to read orders as if they're opening or closing positions, or the reaction to price to that order. And in this case, congestion boxes or range consolidation. Congestion, consolidation, range, different words to define the same thing. And inside a box like that, where you're getting all this price action, what you can't say is that you got longs and shorts duking it out. Some getting chopped up, some that are left long for the rally, some that get too many get stuck short, and that imbalance of what creates the breakout. But inside that box, you're getting everybody trying to fight to get long, stay long, cover their long, cover their short, get short. You got a lot of different opinions in that box. Don't think that the market knows what it's going to do before it does it. It's working itself out, and it's got all the psychology and all the activity of people who are getting long and short for different reasons, who are covering longs and shorts for different reasons. Also, get out of your head that when you hear somebody who's bearish, when you're bullish, you get talked out of it. You have to know that every time you're bullish, there are many people who are bearish. And every time you're bearish, there are many people who are bullish. Don't be surprised that people disagree with you, because they could be wrong and make money, and you could be right and lose money. And that goes down and back to location. That goes back to fire and ready, aim, fire. Most people don't understand the step 1, 2, 3 progression or ready, aim, fire. Everybody has a progression. Most don't realize what theirs are because it's poor, but everybody has a ready, aim, fire. Just most people don't break it down to analyze which one they're good at, which ones they're weak at. And it's just kind of a mess of a bunch of Lego pieces all over the floor. And you never took the time to put them together and separate them, organize them. And then you're wondering why your psychology's all messed up. That's because you got a messed up, unorganized strategy. It ain't in between your ears. It's what your desk looks like. It's what your thought. It's what your strategy is defined. Can you define? Could you clearly tell people what gets you bullish or bearish? How you create your support resistance to sit up in your chair and aim, and then what's your trigger, and then why too many shorts at one particular moment where it flips too long to too short helps you execute an already bullish opinion?